Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, May 27th, 7:40 Mountain Time. Hope everyone enjoyed the long holiday weekend. We wrote a fairly extensive note last week titled "Cleanup on the Treasury Desk." It was very heavily focused on what's going on in the Treasury market. We had postulated a couple of weeks ago that the market's focus would evolve from trade to or the trade deficit to the budget deficit, that the focus would be on fiscal policy. The House did advance one BBBA, one Big Beautiful Bill Act. There were some improvements to the spending side that made the probability of cuts more likely than they otherwise would have been. They were deferred into the future at a point where another administration or Congress could decide to never enact those cuts. But those cuts are still insufficient relative to the longer term baseline, which is government spending at 20.3% of GDP from 1981 through 2019, some $940 billion less than what we're likely to see this year. The cuts are roughly $160 billion. So the spending side remains a problem. A key point of differentiation of our work relative to some of the hyperbole you hear out there or politically motivated commentary is that we are not concerned about taxes blowing out the deficit, and in fact are leaning heavily into a recovery in capital spending as a consequence of the investment portions of the tax policy elements of one BBBA. And so last week we got to a new all-time high for 30-year TIPS yields or real rates. That security's been around since 2004. It went through the all-time high of 270, went straight to 280, it then backed off late in the week. Swap spreads widened further, another indication of supply concerns. And the 10-year term premium models went to 92 basis points. That was negative 25 when the Fed started their rate recalibration cuts back in September. So obviously it had a lot of pressure. It was a global move. But the key message out of our note this week is that this is unlikely to result in any kind of a Liz Truss moment sovereign debt crisis. And that important chart we included in the email associated with this is that when you consider the stock of federal debt, you should not be comparing it to a flow variable like GDP. That's a common benchmark. You should be thinking about it in terms of household net worth or household financial assets. We show that chart in the note, and you see it's been relatively stable since the global financial crisis. In other words, there are sufficient buyers to absorb the debt. Could it crowd out other kinds of investment? Absolutely it could. But we've moved from a period where we had price insensitive buyers like reserve managers, China and Japan accumulating $400 billion each of treasuries back when that was real money in the early 2000s as they tried to suppress their currency to promote exports, to central banks, the Fed buying lots of treasuries in the back end of the market, again, price insensitive buyers, to now price sensitive buyers who will only clear the market at a reasonable price, one with a decent term premium for taking that maturity extension risk. And that's a main message of the note. We then got into a broader discussion about monetary policy and how the Fed is continuing to put pressure on small business sector, housing sector. They need to get over their ideological aversion to trade policy, to higher tariffs, to cutting taxes, to spur investment. They could very well find themselves by September, if they pass on June and July, having to cut 50 because, again, they've caused damage to the foundation of the housing market and the economy and the small business sector, which we don't measure very well in real time. We might find we get another big negative benchmark revision when that comes out in early August. So on balance, we're leaning into being long the beneficiaries of these investment tax cuts, accelerated depreciation for equipment, which, by the way, was weak this morning in the April durables report, but we do expect to pick up in the second half of the year. We're leaning into those sectors, industrials, materials, financials, and we're avoiding sectors that are going to get hurt, get margin compression as a consequence of the increase in the import tax tariffs. And we're not all that sanguine about buying treasuries here. We think they're okay as a diversifier. So we're still at 70% equities and 30% fixed income. That's it for me this week. Please consider becoming a full subscriber to get all these details, really be able to dig in on this, get institutional quality research at an approachable retail price. Barry Knapp from Ironsides. Have a good week, everyone.